Okay, hello everyone. Hi, and welcome to this webinar organized by Docsity in partnership with Syracuse University, Whitman School of Management. I'm Alessandra. Nice to meet you all, and I'll be your host for today's event on behalf of Docsity. So I see here that the first people are already starting to joining in. So, hi, everyone. So we're going to wait a few minutes before starting to allow everyone to connect and to follow the masterclass. And in the meantime, if you want to, feel free to say hi in our chat here on Zoom. And first of all, I want to thank everyone for joining us and thank our panelists for being here with us today. I want to introduce you all to Dr. Fatma Sonmez-Leopold, Associate Teaching Professor of Finance at the MJ Whitman School of Management at Syracuse University, and to know a little bit more about Dr. Sonmez-Leopold. She earned a Bachelor of Science in Mathematics and 2 Master of Science degrees in Mathematics and Engineering Management and Industrial Engineering from Middle East Technical University in Ankara, Turkey. Also, Dr. Fatma Sonmez-Leopold received her PhD in Finance from the University of Toronto, Canada. And her teaching and research interests include empirical asset pricing, investments, corporate finance, and fixed income securities. She has been teaching various courses at Whitman School of Management, among which we have investment analysis, fixed income securities, and introductory finance courses. So together with her today, we're going to explore today's theme, which is monetary policies and fixed income securities. Dr. Fatma Sonmez-Leopold will discuss how monetary policy affects bond markets and how central banks' decisions impact bond prices and yields. We will understand how money controls supply and interest rates and how bond prices and yields can fluctuate. The session will also explore rising interest rates and how they can impact government and corporate bond values and investment choices. So on behalf of Docsity, I would like to remind you that after the presentation, we will have a Q&A session where you will be able to actually ask direct questions to Professor Sonmez-Leopold. So don't be shy and just type all your questions in the Q&A section here on Zoom that you see below, and we will be happy to go through them at the end of the webinar. Also, for your information, and for those of you who are interested in receiving a certificate of attendance by Docsity for this free masterclass, stay tuned because we will be posting the link to get the certificate at the end of the session. So I see here that we have more people joining us, and welcome to those who just joined. And I think that we are able to start now. So without further ado, I'm now leaving the floor to Professor Sonmez-Leopold for her lecture. So thank you again, and I will see you later.
Thank you very much for a great introduction. I'm really happy to be here, and thank you for joining this masterclass. Hopefully we will have a great, very productive hour together. This is a very interesting subject because it's very timely. I think everybody is tuned into the rising interest rates all around the world. We all know through the newspaper articles, we all know through, through cocktail parties that we go to. But today what I want to do is that to really just give you a little bit more framework of that conversation so that you could actually just relate even further. I would like to share my slides with you so that we can talk about based on what I've prepared for this lecture. Now, why do we care about inflation? We all know that the inflation is a situation where the prices tend to rise. Now, the question we generally ask is, well, if you don't like inflation, if you don't like the price rising, why is it zero inflation a good thing for the economy? Or is there any ideal level of inflation? But one thing we are all sure, high inflation is not good news for anyone in the economy. The zero inflation is not good because zero inflation means there is no price increase, meaning the price increases by demand if you fix the supply. Well, if there is no demand for consumption, clearly no businesses need to hire anyone or to do even more production anymore because the demand is actually just is not there. So therefore, zero inflation actually is not good for the economy. In fact, on the other hand, it actually could lead to deflation, which is even worse than inflation. Now, there is a target level. If you are interested, there's a link here. Well, 2% sounds like a good number. How did they come up with this one? The bunch of obviously research is done, and then it came out that the 2% inflation is actually make the economy grow, but not overheated too much that it can lead to higher inflation. So therefore, in actually, let me just go take you there to see this webpage, and this is from Federal Reserve Bank of Cleveland, and they talk about the inflation. Here they talk about when they actually come up with this 2%, which is they issued a statement on longer run goals and monetary policy strategy, where they talk about why 2% is actually the number that they are fixated. Clearly, again, if you go back here, after the Federal Reserve Bank, which is the U.S. central bank, every country has a central bank, right? The Federal Reserve Bank is the central bank of the United States. After central bank came up with 2%, all around the world, all other central banks adopted this 2% inflation rate idea. Now, I would like to focus on the Federal Reserve Bank very briefly. The Federal Reserve Bank have a dual mandate, which means they have two main goals. One is to promote maximum employment, so they have to keep on labor market. And the other one is price stability, meaning keep an eye on the prices of the goods and services. So this dual mandate is really crucial to understand the monetary policy. Now, when you look at the Federal Reserve Bank's role to control inflation, they control inflation by influencing interest rates, i.e. the federal fund rates, which I'm going to talk about in a minute. So the main goal is the idea is the following. Why they are actually focusing on interest rate while they are controlling inflation is that because interest rate is the price of money, like the price of goods and services. There is a price for money. So the price of any goods and services is determined by supply and demand. So in this case, because we are looking at price of money, so this price of money is determined by the supply of money and demand for money in the economy. So when the supply of money increases, as you might imagine, then obviously assuming demand is fixed, the price will go down because there are too much money in the economy, like too much apples in the economy, and there are very few or fixed demand for this apple. Clearly, the price of apple goes down because you don't want them to go bad, so that you just sell it for cheap. The same idea here, when the money becomes too much in the economy, then the price goes down, i.e. the interest rates goes down. On the contrary, if the supply of money decreases, meaning the money becomes now more scarce, so therefore the price will go up because now it's hard to find that apple, hard to find that money. So therefore the price of money will go up, which is interest rate goes up. So the Federal Reserve Bank is going to control inflation, and while doing that, they're going to use the supply of money, which will determine the interest rates. Now, what is a federal fund rate? Remember, I said the interest rate that they are controlling. That specific interest rate has a name. It's called federal funds rate. So this is a short-term interest rate that the banks charge, or the charge each other for overnight loans. So the Federal Reserve Bank sets a target range, not even a level, a range, and the banks, when they borrow from one another, they lend and borrow around this range. So the Federal Reserve Bank uses this target range to communicate its monetary position. So if they increase this rate, clearly you would understand that they are trying to increase the interest rates. Now, there are two basic monetary policy. One is an expansionary monetary policy. As you might understand from the name of it, the Federal Reserve Bank is going to print some money. I mean, I don't want to go too in depth. I'm not even talking about physical money. Sometimes we're talking about digital money. I'm not talking about Bitcoin or something. It's just, you know, printed. When we talk about printing money, we talk about real cash. When Federal Reserve Bank prints money and injects into this money into the economy, then obviously the supply of money goes up, the money becomes cheap, so the interest rates are lower because it's the price of money. So this lower interest rates encourages consumers to increase their spending, because then it's cheaper to buy a house because borrowing is cheap. We can buy cars because the car loans are cheap, and the business can invest more because they can actually borrow at a cheaper rate, so they can actually invest into new equipment. So the consumption goes up. When the consumption goes up, clearly this could be an incentive for businesses to increase production, hire more labor, and spend more on resources. So all these increases in spending ripple through the economy and likely moving the unemployment rate down towards its full employment, so the inflation could possibly move up. That is one scenario where you want the economy to, this is a scenario where inflation is actually low, and it's not around 2% target level, it's less than 2%. And we want the economy to consume more. We want the people to consume more, to really just give the economy a push to go to the target level of 2%. And then you try to expand the monetary policy. The other side of the story, the flip side of the story, is the contractionary monetary policy, where this is a scenario where inflation is high, like we are today, and we are trying to cool down the inflation. We're going to calm down the inflation. And the way the Federal Reserve Bank deals with that is that they need to take out the supply of money from the system so that the money becomes expensive, i.e. interest rates become higher. So when the interest rates are higher, clearly we do not have incentives to consume. On the contrary, we have now incentive to save because our money is actually more valuable right now. And this saving preference will clearly lowers our consumption on goods and services, and the businesses actually starts not invest in real investment only because now money is more expensive. So the decrease in consumption leads to decrease in production, and clearly now the businesses do not need that many workers, so therefore they hire fewer people, so that will actually lower the employment, and there are less spending on other resources. So all these decreases in spending ripple through the economy, and the demand for workers could lessen, inflationary pressures will diminish, hopefully, and the inflation rate would fall back toward 2%. As you might imagine, this is not like there's not a magic wand where you actually just make this policy and tomorrow inflation goes down to 2%. As we have seen over the last couple of years, inflation is rather sticky, and your monetary policy will impact with a lag. And this lag could be 2 years, could be 3 years, depending on how deep the problems are. But given the latest situation of the world, where inflation is created rather from a supply part of the story, the inflation looks like more sticky than ever. So always remember, these monetary policies would not have an impact immediately, with rather with a lag. Now, what type of tools Federal Reserve Bank uses to control this interest rate or the supply of money? And there are several tools. One of them is reserve requirements, which is the banks are required to hold reserves. So when you go to a bank, when you deposit some money, portion of it needs to be kept by regulations. And the rest of your money will be given as a loan to other people. So that's what the banking system actually depends on. As you might imagine, all these reserve requirements could be changed over time depending on whether you want the banks to loan that money to the public or not, right? So then you can play around with that number so that you can actually just limit the reserves that are going outside of the bank. And in addition to that, the excess reserve in the bank could be loaned out to other banks. And remember the federal fund rates, the overnight rates, the banks borrow from one another. They are actually lending and borrowing this because of this reserve requirement. Some banks maybe not, they do not have enough reserves to really satisfy the regulations. So they go out and borrow money. Or they might have excess reserves that they loan to the other banks that they need reserves. So that actually is the federal funds rate. The other tool is the discount rate. This discount rate is different than the federal fund rate. Federal fund rate, as I said, is used to borrow and lend among banks based on their reserve, excess reserves. A discount rate is the banks borrow from the Federal Reserve Bank. So if you think about the central bank, any central bank is the father of banks or the mother of the banks or the parent of the banks in the country. So when the other banks need money, they could borrow from the Federal Reserve Bank, and that rate has a name. It's called discount rate. So the Federal Reserve Bank can change this discount rate so that could also used as a tool to control the money supply in the economy. And this rate serves as a ceiling for the federal fund rate. This is higher rate because Federal Reserve Bank borrowing is the last resort for a bank, because bank has other alternatives. They could go and borrow from the other bank at a federal fund rate. As a last resort, a bank can go and borrow from the Federal Reserve Bank, and that rate is actually higher than the Federal Reserve Bank. As you might imagine, that's a last resort. And the other tool, which I'm sure many of you are familiar with it, is the open market operations. Meaning, there is a part of Federal Reserve Bank which is their sole purpose is to buy and sell securities in the market. So when they need to inject money into the economy, they go buy securities on the open market from other institutions, and by this way they can inject money into the economy by buying some securities. Or when they want to collect money from the market, they could actually just sell some securities. So by doing open market operations, a Federal Reserve Bank can control the supply of money in the economy. So how does inflation affect bonds? So far, we understood that inflation is not good. There's a target level. And there are two different policies that any Federal Reserve Bank can follow to reach that goal. And there are some certain tools to do so. But when you look at the bond market, which is quite a big market among all the financial markets, because bond market is a lending and borrowing market. Bond is actually the basic principle is I owe you money. So this is a binding contract, that's why it's called financial obligation, between a borrower, i.e. issuer or debtor, and the lender, which is called also creditor. So there's a borrower, there's a lender, and between these two parties, there's a financial obligation. So the borrower says, I'm going to pay your money back at a specified time period. So as I said, the basic principle is I owe you money. Well, the return on this onto this bond, which means when you lend, what you want to earn is two things. One is periodic fixed interest payment, because when you pay $100 to someone, not only you get your $100 back, but you get some interest on top of it. And then the other thing is, well, there is an increase in the bond price because it's a piece of paper, and then you can sell in the secondary market. So that piece of paper has a price, and then you're hoping that price will go up, which is capital appreciation, because you want your money to appreciate over time. So if you want to look at a little bit more, more in a more framework, what you can see in this is like if this zero is when the borrower borrows, and then when you lend, if you take that time as zero, so every year you receive interest payment. That I represented interest payments, a fixed amount, the same amount every single period. And at the end of that fifth year, you receive your face value. This here is F with capital F. That face value is what you give at time zero, because you give 100, you get 100 back at the end of the fifth year. So that 5 as a name is called maturity date. So the date on which the bond actually pays all of this interest payment, and it's the date that's the expiry date on the bond. All right. So the bonds can have a short, medium, or long maturities. It could be 1 year, it could be 5 years, it could be 30 years, 100 years. There are some 100-year bonds out there. But this number is a fixed number. You can't change it after you enter into a contract. You have to pay your debt back in 5 years based on this picture. Similarly, when you look at the interest payment calculations, what you see is there's a coupon payment here. The coupon rate here is 3%. Let's assume the bond says, I'm going to give 10% of the face value, which is 100, what you give. So, or 1,000, whatever that number is. You have a fixed payment. This is considered to be I, until the end of the maturity. Let's assume you're going to receive 100, 100, 100, 100, 100, and plus 1,000 at the end of the fifth year with a 10% interest rate, with a 10% coupon rate. That's your fixed payment. Then we have a yield. When I'm sure you're thinking right now, if everything is fixed, what is changing here? Because the face value is fixed, right? This number is fixed. Interest payment is fixed. N is fixed. So when you look at this whole thing, something has to change to calculate the bond value. Well, the yield, the translation is the rate of return on the bond, which is your return that you want to earn from this bond when you buy it, changing over time based on the prevailing interest rates in the economy. So therefore, the whole interest rate idea and the bond valuation depends on this one particular input, which will be affected by the interest rates in the economy. Well, this is the bond valuation. Don't be scared of the math part of it. When I teach this subject for many, many hours, clearly I explain every detail in this equation, but very quickly, this coupon payment is $100 that we were talking about, which is this one, $100. So you have $100 for 5 years. YTM is the yield, that the return that you want to earn. So you do it for 5 years. So the first term is the present value of the coupon payments. You want to know what's the amount of that 5 times payment. If you do here, if I ask you without knowing any finance or any time value of money, you would just say, oh, what's the total value of this 100 here? You would just say 500 because there are 5 of them, right? That's not bad, but you miss the inflation, you miss the interest rate calculations in that very simple calculation. You just said 5 multiplies 100, ignores time value of money. So this piece here takes into account interest rates. That's what it says. Okay. And then clearly I also have to add the face value, because not only I have 5 times the 100, but I also have 1,000 here. So this is the time value version of it. This is the interest rate taken into version of this one. So as a result, what you calculate is a bond price. But what I want you to give attention to it, if you look at this mathematical expression, what you would see, yield, in other words, the YTM, yield to maturity, which is you buy the bond today, hold it until the maturity. That's what you earn. Say you earned 10%. This number is in the denominator. Why do we care? Because when it is in the denominator, when you increase this number, bond prices will come down. This is a mathematical explanation, right? Because this goes up, this goes down. In more economical explanation, which I will come in a minute, YTM is affected by the interest rates in the economy. And when we increase the interest rates in the economy, clearly you will see new bonds outstanding coming to the market with a higher rate. So the existing bonds will lose value over time, which I will speak in a couple of seconds. But I want you to really give attention to one very important fact, which is bond prices and yields move in the opposite direction, like a seesaw. And that is a very important fact in the bond market, which is when bond prices goes up, yield goes down. Or when bond prices goes down, yield goes up. And that's very crucial, because when the interest rates, when the Federal Reserve Bank meets and makes a decision to increase the interest rate, that will affect this yield here. So this will go up. As a result, this will come down. So therefore, bond markets, the traders in the bond market, listens to the Federal Reserve Bank's interest rate decision very, very closely for this very important fact. Now, when we look at the fixed income market, now I would like to now refer as a fixed income market, because you know from this picture, let's go back again, maturity is fixed, face value is fixed, interest payment is fixed. So therefore, there's a general name to this market. It's called fixed income securities market. Now, when you look at this fixed income securities market, we have to understand the inflation has a huge impact on it. Now, if you buy a house, you might pay attention to the recent news about the rising interest rates. Well, when the mortgage rates goes up, clearly fewer people can afford to buy homes, and that could actually dampen the housing market, which in turn can affect the whole entire economy. And when the Federal Reserve Bank raises its target range for the interest rate, which is the federal fund rates, which is, remember, the short overnight rates that the banks borrow among themselves, the all other rates and the bond yields typically rise as well, meaning the mortgage rates follows, all the bond yields follow, every single thing in all the other interest rates in the economy follow this rising interest rates. And that's because the bond issuers, whoever is borrowing, remember the issuer is a borrower, must pay a competitive interest rate to get the people to buy their bond. They have to really incentivize people to lend them, otherwise no one will come and give you money. So this new bond paying higher interest rate mean the existing bonds, remember the bonds that are issued a couple of years back when the interest rates were low, becomes less valuable, because now you, as an investor, you have a choice between a new bond, which is giving you higher interest rate, versus an existing bond, which was issued back in the days, giving you lower interest rate because it was issued when the interest rates are low. When you, as an investor, when you're looking at these two bonds, if you want to buy an existing bond, which is the issued back in the days, you will not give the same amount that you are going to pay for the other one, because now it's less valuable to buy the existing bond because they actually do not pay you enough money. So therefore, the prices for existing bonds fall. And if you're holding that bond as a bond investor, you'll be upset with it because you're now losing money. Remember, we talked about return on the bond comes from two places. One, fixed interest payment, to hopefully you will earn money, price appreciation. Now your money is not depreciating, your price is actually depreciating, and that's not a good thing. So obviously inflation and rising interest rate has different impact on different bonds. Short-term interest rates may feel the impact of any Federal Reserve Bank action almost immediately. Why almost immediately? Because federal fund rate is a short term interest rate, right? It's an overnight interest rate. So therefore, any short-term other bonds that are like 1 month, 3 months, 6 months, up to a year, they may feel the impact immediately. You might see a reaction immediately. Longer-term bonds, like 5 years, 10 years, 30 years, 100-year bond, although they will see a greatest price increase because longer means uncertain. Future means uncertain because you don't know for sure what's going to happen for the next 10 years. They will see the greatest price change, but with a lag. And also the mutual fund, bond mutual fund may have a different, they might be affected differently by the inflation and rising interest rate than an individual bond, because the bond mutual fund is a collection of bonds. So therefore, especially if they are actively managed funds, the money managers could actually just implement some strategies that could eliminate or minimize the interest rate changes impact on the bonds, and that could actually just have a less impact on the mutual fund bond portfolio, whereas individual bonds are directly impacted because there is no strategy around it. You're just owning one individual bond. I think this picture is really very important, only because this actually summarizes everything I just said about the short term versus the long term. If you look at this picture, this is over time. I'm looking at from 2002 to 2023, which is up to this year. If you look at this graph, what you see is the blue line is the effective federal fund rate, which means the federal fund rate that is set a target range at 2% by the Federal Reserve Bank, right? So, no, sorry, that's an inflation. So that's a effective federal fund rate that was set by the Federal Reserve Bank to control the inflation to come to the target rate at 2%. The red line here is the 3-month Treasury bill, which is a short term. The government is borrowing for 3 months. If you look at that, it's almost identical. So therefore, when you look at that, it says the short-term interest rate may feel the impact almost immediately, which you will see they are moving up and down almost simultaneously. Whereas when you look at the long term, we have the green one, which is a 10-year treasury. We have a purple line, which is a 30-year treasury. They are long-term, right? 10-year and 30-year. The government is borrowing again because this is US government securities. When you look at them, they actually follow the trend. They see a little bit more change, but with a lag. So therefore, the long-term and the short-term interest rates are affected by the inflation, by the Federal Reserve Bank's response to the inflation differently. By the way, I took this picture from Federal Reserve Bank St. Louis webpage. This is right here. You can find that webpage. Now, I want to look at some of the news in the market. This is just a couple of days ago. This is from Wall Street Journal. This is last week when we heard very strong hiring from the economy. So the labor market is actually very strong. So it surprised everybody. That's why the title says surprisingly strong hiring. It's a surprising market. So, this surprising news actually sends the bond yield higher, only because before this news, everyone is expecting that the Federal Reserve Bank is going to cut the interest rates because the inflation was cooling down. So the response was going to be the Federal Reserve Bank is going to cut the interest rate, which when they cut the interest rates, the yield goes down, so the bond prices come up. But on the contrary, this strong hiring send a signal that the Federal Reserve Bank may not cut the interest rate going forward. So therefore, the bond market got panicked, and then they started to sell more, and then which the bond yield goes up because they are inversely related. Now, who are the major borrowers in the economy? There's a treasury market, there's a corporate bond market. Obviously, there are more municipal market, there is international bond market, there are tons of other bond markets exist, but I'm going to focus here two of them, treasury and the corporate bonds. And obviously households like you and I, we borrow for a variety of reasons. Now the treasury bond market is actually, the issuer is the US government. On behalf of US government, it's the Treasury Department who borrows on behalf of the US government. And they are considered to be risk-free bonds. Why they are considered to be risk-free bonds? Because they are the US government is default-free. Default here means bankruptcy. So when you talk about the risk in the bond market, the major risk is the default risk, which is, can I get my money back from the borrower? When you look at the corporate bond market, the issues are the corporations, and they are risky, right? Because even the best financially healthy corporations, they still can go bankrupt. You never know what happens. So therefore, corporate bonds are risky as opposed to treasury bond market. So therefore, we use the treasury bond market as a benchmark in the economy. Now, there are three types of treasury bond, borrowing. One is a short term, which we call treasury bill. So these are 1 month till 1 year bond market. And we have the notes, which are issued 2 to 10 years. And anything beyond 10 years borrowing is considered to be bonds. So this is short term, this is mid-term, and the bond is the long term. And I would like to show you the rates as we speak at the moment. And here is the Wall Street Journal bonds and rates market. If you look at here, you see the Treasury borrows for a month. That's why it's called bill. Treasury borrows for 6 months. It's called bill. Borrows for a year. It's called bill. So this is a short-term borrowing. And if you look at the yield here, this is what you would earn on an annualized basis. So if you invest into a 1 month bill, you will earn 5.4% per year annualized. And as you see, if the US government borrows for 2 years, it's called note. 5 years note. Up to 10 years, it's called note. So up to 10 years, between 2 to 10 years, it's considered to be note. And these are the yields on them. If you invest into US government bond, 10 years, you will earn 4.69% per year. And anything beyond 10 years is called bond, and you will earn 4.8%. So these are the different maturity bonds in United States, and these are the rates as we speak. Now, when you look at the yields, remember we just saw the yields on the Wall Street Journal bonds and rates webpage. We see the yield, this is the YTM, which is the yield on the treasury. They're considered to be risk-free rate. So if someone asks, what's a risk-free rate in the economy, you should go check it out, that webpage that I just showed it to you. And that will give you the risk-free rate in the economy. Whereas the yield on the corporate bond, because it's risky, it is composed of two things. One is the risk-free rate, which is the yield on the treasury, whatever this rate is, and more. So which means when you invest into risky corporate bond, you are asking, I need to earn at least what the government is paying and more. I want to earn more because you're risky as a corporation. How much more depends on the risk of the credit, meaning the credit rating. That's why the credit rating comes into handy, because you want to know how risky the corporation based on their credit rating. So that's a credit risk. So therefore, when you invest into, say, Tesla, bond. You're buying a Tesla bond. So the yield on Tesla bond when you buy, you're just saying, at least I need to earn, say, 5% right now is the risk-free rate. I just showed it to you on the Wall Street Journal. And if it is 5%, you need to earn more than 5% because that's the credit risk on top of everything. So why do Treasury borrows? Why do corporations borrow? Treasury borrows to spend on many things, like Medicare, like infrastructure, like education, military. So there are a variety of things the Treasury should spend money on, because the Treasury is like the parent of the household. They have certain incomes through taxation, and then they spend some money. But most of the time, the U.S. The governments don't have enough money to spend on things. That's why we call it deficit, because your income as a Treasury is lower than your consumption, your spending. So therefore, the Treasury has to borrow to close that gap, because you don't have enough money to spend on things. So the Treasury borrows when there's a deficit. Right now in the United States, we have a huge amount of deficit, and the U.S. government has to borrow. Now, the corporations borrow for a variety of reasons, but mainly to invest to grow, because the corporations have, say, good projects, and those good projects need money to invest into, so that the corporations has to borrow. By this way, they can actually grow, and then each individual corporations grow, the economy grows as a whole. And the households borrow to buy a house, to go to college, for a variety of reasons. But overall, every agent in the economy needs borrowing. So therefore, when you borrow, we need to take into account the uncertainty in the inflation going forward. Because when we borrow towards future, because we are going to pay it over time, we need to think about the expected inflation. So if you're a borrower and you borrowed thinking that the inflation is going to be higher, lower, you're just saying, well, I'm borrowing, the inflation is going to be, say, 2%. But if it turns out that the inflation is actually higher than what you expected, so the inflation is 5%, you expected 2%, then all of a sudden, as a borrower, you benefit from this, because your repayment, remember, you have to pay interest payment when you borrow, because they're all fixed amount, then you pay out lower than what you anticipated initially. Although the amount is the same, you pay $100 every period. But when you think about inflation, is actually the purchasing power, right? So the $100 today may get you 5 burgers if the burgers are $20. If the inflation is higher tomorrow, you won't eat 5 burgers, you will eat less, right? So even though you have the same amount of money, the purchasing power is lower due to the inflation. So therefore, the borrower benefits, although they give the same amount of money. When you account for inflation, that money is not the same amount, actually. On the contrary, if you are a lender, and if the inflation turns out to be lower than expected, right, then you benefit, because, as I said, because of the inflation, repayment will be higher than what was anticipated both parties. So what I'm trying to tell you is that this unexpected inflation or unanticipated inflation transfers wealth from borrowers and the lenders arbitrarily. So when you enter into a contract, you have a number in your mind as an inflation, and that's why all these numbers are calculated based upon that. But after this, maturity date, when you look back, and if the inflation is actually just different than what you anticipated, you might benefit, or you might actually suffer from it. So therefore, borrowing market actually directly affected by the inflation. Now, if I need to conclude, there's a target level which was put forward by the Federal Reserve Bank in 2012 as a 2% for developed countries. And central banks, the Federal Reserve Bank for the United States, aims to stabilize the inflation by changing the interest rates around this 2%. So when inflation is too high, like the way we are in now today, the Federal Reserve Bank typically raises the interest rates to slow the economy and bring inflation down. That's called contractionary monetary policy. And when inflation is too low, the Federal Reserve typically lowers interest rates to stimulate the economy, and that's called expansionary monetary policy. And all other rates, such as mortgage rates, car loan rates, bond yields in the economy, move up and down by the Federal Reserve's target range for the federal funds rate. And thank you for listening and joining, and I can take the questions now.
Perfect. Hello again, everyone. First of all, I want to thank Professor Sonmez-Leopold for the thorough presentation. And I see here that we already have some questions from the participants. So in the meantime, I'd like to remind everyone that there's still time to ask questions to the professors. So you can just do it by writing here on the Q&A box on Zoom. So let's start with the first one. The first one is from Maria, and she asks, she says that she didn't understand what were the Fed's tools. And she asks, how are they used in the economy?
Oh, that's a great question. Let's talk about open market operations. Remember, I said monetary policy is all about supply of money in the economy. And how can you raise that money supply in the economy? How can you put lots of money into the economy? One way to do it, say I'm a Federal Reserve Bank. I come to a bank and I buy US Treasuries from the bank. And when I buy that US Treasury, I need to give money to the bank. So when the money gets into the bank's account, now the money can actually be distributed as a mortgage or as a car loan or as a student loan to other people in the economy. So I, as a Federal Reserve Bank, I just printed out money out of thin air, right? Think about it like that. And then I come to the bank, give that money, but in exchange, I can't give the money just like that. I can't just say, take this money and go home. I can't do that. So what am I going to do is I'm going to buy something from the bank. By doing so, the money will go to the bank, and then bank will take it to the end users like you and me, like all other people. So that therefore the money goes to the economy. So through this channel, the money travels to. Okay, so another tool, for example, or on the flip side of it, say too much money in the economy, i.e. we're spending too much. And the Federal Reserve Bank says, well, you're spending too much. We have to cut the spending. Why? Because inflation is too high. Inflation means, look, inflation happens through two channels. One from the demand side of it, which means we buy products constantly, so we raise the prices. Or the supply side of it, maybe there's not enough of it, even though demand is not increasing. Maybe there's not enough of it. So that's why the price is high. Think about like an apple. Let's assume there are very few apple farmers out there. All right. So if there are very few apple farmers, clearly the price of apple goes up because it's not very valuable. There's very few of them in the economy. That's the supply side. Let's assume now we have enough apple, but we also have a ginormous demand for apple because everybody wants the apple. Everybody wants the apple. I don't know why. Everybody wakes up one day and everybody's running to the supermarket to buy apple. That's the demand side of the story. It's the same thing for money. So if so let's go back to inflation again. So if nowadays, or for the last couple of years, not necessarily from the demand side, but from the supply side, we have problems because of variety of reasons. There is war in the world. There was COVID. So there was a distraction to the supply side of the story. So therefore, many people couldn't find products, especially commodity. So the prices goes up. So therefore, inflation is higher. So the Federal Reserve Bank is saying we have to cut these prices. The way they are going to cut it, to play around with the consumption, because they are saying, well, we can't do anything with the supply. We can't people to produce more or whatever. So what we are going to do, we're going to cut the demand, the consumption. How can we cut the consumption? I'm going to give you an option to save. I'm going to say, look, if you save, I'm going to give you a ton of money. I'm going to higher the interest rate. So if you don't spend, you can actually do well. So how am I going to collect the money from the economy? I, as a Federal Reserve Bank, I'm going to now sell the security. I'm going to, the U.S. Treasury, U.S. Treasury going to sell the securities, and they're going to collect, because when I sell, you buy, so you give the money to me, so that the money is going to be taken out of the economy. That's a open market operations. There are other tools, aims the same thing. So the entire tools, and there are not three of them. I just give you three. There's a bunch of it out there. They're all determined to play around that supply. The idea is the end users, like you and me, are we able to get that money cheap, right? And which means when we go to a bank, does the bank have money? Where does the bank get that money? From the Federal Reserve Bank system. I hope it helps.
Perfect. Thank you, Professor, for the very clear explanation. So staying on the theme of Fed's tools, we have another question here, which is, of the Fed's tools, which tool is more effective in controlling money supply?
Oh, that's a brilliant question. It depends on what type of crisis that we are in. Let me remind you, 2008 financial crisis. During that time, I don't remember, I don't know whether you remember the extent of it. It was all come from the mortgage-backed security market, which was the real estate market. Remember back in the days, people borrow money based on their, you and I, we borrowed money from the bank to buy a house. So the bank piled up all of our borrowing, and they sold it to another bank, and then the other bank sold to another bank. So this thing bundled up, and no one knew who's in this bundle. It could be very risky buyers, like maybe a person who doesn't have a job, and therefore they default on their mortgage, and that default could actually lead a disaster in the higher end. So that happened in 2008. During that time, they use an extraordinary tool, which is called quantitative easing. So that tool is not used on a regular basis, because that's a very hardcore measure, which is they still buy, but they buy long-term corporate bond, long-term mortgage-backed securities. They basically bought almost all the long-term securities that are actually toxic in the market. We are talking about Federal Reserve Bank. So the Federal Reserve Bank, by buying all these toxic things, they inject enormous amount of money to the economy through that system. And that's the year we actually reached almost zero interest rates in the economy. The borrowing was superbly cheap. So great question, which tools? The tools that I just mentioned, they're on a regular basis tools. They are used on a regular basis. The reserve requirements, they move around, the discount rate, they move around. And they also, during that time period, 2008, they also started to give interest on the reserves that the banks are using. So that wasn't a tool back in the days until that year, because the banks started to keep higher reserves, and they needed to be compensated for the reserve that they are holding. And then the Federal Reserve Bank decided to pay interest on those reserves. So there are many other tools, depending on how deep the problem is and how fast it should be solved. Obviously, every single solution, like the medication that we receive, think about like fever. You have a fever, that's an inflation. You're trying to calm it down. The question is, let me just lower my fever. You take a medication. But how much medication you will take depends on how old you are, how sick you are, how high your fever is. You can't give the same medication to me and to my daughter who is younger. You change the level, right? So the solutions to the fever always depends on variety of different factors, like the fever that I'm talking about. The fever back in 2008 was very high. You needed higher medication. You just said, look, the patient is going to die. We have to give an extreme medication to this person. Whereas now, it's not extreme fever. We have fever, but a controllable fever. So it's kind of like you have to know many, many different deals. Like, for example, right now we are dealing with rising inflation with a full employment. So this is like a different time period. So we have to use different tools. I hope it's a clear answer, but there is not one answer, unfortunately. There are a variety of reasons why we use different tools.
Perfect. Thank you, Professor. So to move to the next one, we have Deborah that asks, how does the lender benefit from the inflation?
How does the lender benefit from inflation? Lender does not benefit from inflation. If the inflation is high, you receive fixed income, right? So you receive $100 today, you receive 100 next year, 100 the following year. So the inflation is higher. Your purchase, although you receive the same amount of money, but the things that you can buy with that same amount of money is not the same. So inflation actually is not a good thing for a lender. So what happens is that the lender, unless they invest into inflation-adjusted bond market, there is one. It's called TIPS, Treasury Inflation Adjusted Securities. So if you want to buy during the inflation period, you buy those kind of securities, not a fixed income, because it becomes a really a problem. But here's one thing that I could say for a lender. If you buy the bond and if you hold it until the end of the maturity, say you buy a bond for 2 years, which I encourage. Don't buy anything longer term right now. If you buy shorter term, which means you can wait for 2 years. You don't have to sell your bond for 2 years. As long as you don't sell, it doesn't affect you really. In terms of like the fixed income part affects you, but the price depreciation does not affect you because you will receive your face value at the end of the maturity. So you won't be affected by the change. But if you decide to sell in between, that's why the long-term securities are not something that people are right now buying. If you're buying a long-term security, clearly you have to be very careful, not only the fixed income payment of it, but also the price depreciation part of it.
Okay, perfect. Thank you. And let's move to the next one. We have here Stephanie that asks, can you explain how the timing and magnitude of bond cash flows are determined and how they differ between different types of bonds? Thanks.
Great question again. Oh my God, your audience is fabulous. Now, the timing. Most of the time it's 6 months, the coupon payment or the interest payment. This is for many US bond market operates. Unless it's a different type of bond, it's generally a semi-annual payments every 6 months. The coupon is paid. And they're all determined at the time of the issue. So when the bond is issued, meaning when the borrower borrows money, when they write the contract, they write the periodic payments. The timing is determined based upon what the bond convention is. The bond convention, meaning the rules, are 6 months most of the time, unless this is some sort of a Euro bond or different type of bond. But for typical bonds, typical fixed income security, we call it plain vanilla bonds. They are 6 months. And the magnitude determines, that's a critical question, determines what's the prevailing interest rate at the time of the issue. It's like mortgage rates. When you go to the bank to borrow money to buy a house, they will tell you the current mortgage rate is 7%. Okay, current. You shake hand, you get your money, you agree to pay 7% for the next 30 years. That's a mortgage market. Now, 2 years later, mortgage rates goes down to 3%. You're obviously not very happy because you fixed your mortgage at a 7% for 30 years. Unless you refinance it at 3%, you're fixed to pay 7%. It's the same idea with the bond market. They fix that amount, that magnitude, at the day of the coupon payment or at the day of the issue. So when they borrow, like the way you borrow from a bank as a mortgage taker, they fix that amount based on the current interest rate. And as time goes on, clearly that rate is changing. Therefore, the new bond outstanding, as time passes, the new bond people come into the market, they have to issue at the prevailing interest rate. Otherwise, no one will buy that bond. I hope it was clear.
Absolutely, thank you. And then we're going to move on to the last and final question. Here we have, could you go back and explain what open market operations are?
Okay, great. I think I explained it in another question when the tools are was explained, but I could say that one. Open market operations mean the Federal Reserve Bank buys security in the open market, which means from the other commercial banks. They buy the bonds from other banks, and then when they buy them, they have to give money to these banks. So the banks, when they have this money, they distribute to the whole economy. So that's an open market operations. There's a part of the Federal Reserve Bank that is responsible for it. That's the New York one, because Federal Reserve Bank of the United States has a different system than many other central banks in the world, which is it is composed of a variety of different boards. There's a Federal Reserve Bank of Cleveland, there's a Federal Reserve of St. Louis, there's a Federal Reserve Bank of New York. That unique decentralized organization gives a unique element to the Federal Reserve Bank. Why? Because the Federal Reserve Bank collects information from different places like Cleveland, like, San Francisco, like New York, and they put together to make a monetary policy. And New York Federal Reserve Bank is the one that is responsible for the open market operations. So the New York Federal Bank, Reserve Bank, goes out to the public, to the commercial banks, and buys securities from them or sell securities to them. And by this way, they can either give the money by buying or get the money from the economy by selling. So that's what the open market operations is.
Okay, perfect. And thank you again, Professor Sonmez-Leopold. And we also have the students here in the Q&A box thanking you for all the explanations.
Oh my God, let me see their answers. I want to see it.
Yeah, Maria says, thank you so much for the explanations.
Oh, of course. Thank you, Maria. Thank you.
Okay, so again, thanks to everyone for being with us today, and especially to our panelist, Dr. Fatma Sonmez-Leopold.
Thank you.
And I'd like to remind everyone interested in receiving a certificate of attendance by Docsity that you can request it by clicking on the link in the chat. And also, before we say goodbye, I would like to ask Dr. Leopold if she would like to leave the students, the participants, with a message.
Oh, yes. Read the news every day, especially financial news. It's just so important because, we need to be connected. We need to be engaged because life is passing so fast. News travels so quickly. I think the social media is great. Have fun. But I think following the news, financial news especially, clearly all other news because they're connected to one another. We don't live in an isolation. It is critical for our understanding about what's going on. And just having a book knowledge is not enough. Having book knowledge is great. That makes us great nerds, and I'm very proud of it. But also equally, we need street knowledge that will keep us engaged with the rest of the world. And have fun. Have a great day. Enjoy your time. Thank you for being here.
Okay, perfect. Thank you, Professor. And I think that your lesson was really useful for everyone, and I was also able to learn something from it.
Oh, that's great.
So, thanks again to the professor, and thanks to everyone. And I hope to see you again in the next webinar organized by Docsity in partnership with Syracuse University, Whitman School of Management. So bye, everyone, and have a nice day.